Okay. I am Memo Fugeng, Subject Advisor for Economics. I'm going to take you through the topic of inflation today. We are going to do inflation today, and you know by now that when we start every topic, we first have to understand what the main topic means. We need to understand the description of the main topic. The topic for today is inflation. And before we go into details about what causes inflation, how do we calculate it, what are the consequences, we first have to understand what the concept means. Now, we say inflation. Remember, in economics, we always say there are elements of a description that are very important when you describe a concept. Because we have so many textbooks that we are using, it is always important that in all the textbooks that we have, we incorporate the elements of description as expected. Now, when we think of inflation, we think of a continuous increase. What is increasing? The general price level of goods and services over a period of time. Now, what is important for you to note is that in inflation, we don't talk about an increase that is happening once off. It has to be continuous. And there should be an increase. Now, we are not looking at the price of one item. We are looking at the general price. The general price of goods and services over a period of time, which will usually be a year. Now, we say as prices rise, the purchasing power of money decreases. In other words, when the goods become expensive, money is no longer able to buy the same amount of goods that it used to buy. Now, let's look at our example. If inflation rate is 5%, a product that costs 1 rand today may cost now 5 rand the following year. This is because the power of money decreases. In other words, 100 rand will no longer afford you to buy the product that you bought this year if inflation increased by 5%. Now, this item now, because of the 5% increase, the item that you used to buy is now 105. In other words, if you only have 100 rands, you will no longer be able to buy that item. Right. Now, let's look at all right, sorry for that. Now, how do we measure inflation? We measure inflation by means of indexes. The indexes that we are talking about is consumer price index as well as producer price index. We measure inflation by means of the weighting. We look at the basket of goods and services that a typical household can be able to buy. Now let's look at this one. We'll move on to the next one. In terms of indexes, we have the producer price index as well as the consumer price index. Now, looking at the word consumer and the word producer, already it should tell you that the consumer price index is looking at the households and the producer price index is looking at the firms. Now, with the consumer price index, we say it measures the change. We measure the change in the prices of goods and services, which is purchased by who? Purchased by households. Remember, I said whenever we think of a consumer, we think of households. So when we look at the consumer price index, is a tool that we use to measure inflation. But with the consumer price index, our focus is on how much can the households afford. Now we use this as an indicator of inflation. In other words, in our country, when we check inflation, our main focus is on the consumer price index more than the producer price index. So whenever we look at how much is our inflation rate, we check how many goods are households able to purchase. The higher the inflation rate, the lesser the goods that households are able to purchase. Now, consumer price index includes food, transport, housing, education, health, and other household expenses. So when we look at how much can the households afford, we look at these things that are mainly expenditure by the household, which is food, transport, housing, education, and all the other the housing expenses that we incur in our households. Now let's look at the producer price index. The producer price index, on the other hand, it measures the changes. It still looks at the price. Now, the price received by producers and manufacturers. What does that mean? It reflects inflation at the production stage. Producer price index looks at inflation where? At the production stage. So consumer price index looks at inflation at the consumption stage. Now, with the producer price index, it serves as a warning, meaning it's somehow a leading indicator for future inflation. When the producer price index increases, it tells us that meaning if the price of goods at the production stage, the production costs and all those things, if there are more production costs, we know that firms always want to make profit. So if they incur more production costs, they are going to transfer those costs in terms of higher prices to the consumers. Now we look at the weighting, we look at the basket of goods and services. And then we say, Statistics South Africa compiles a representative basket of goods and services consumed by households. Different items are given weighting according to their importance in household spending. Now, in terms of weighting, we look at, remember we said households spend money on food, transport, housing, etc. Now, with the weighting, we look at the weight of these goods that the households are spending money on. For instance, we can say households spend 60% of their income on food, for example. So if this is the case, then it means on the weighting basket, food will have a higher weight. Now let us look at how do we calculate the inflation rate. When we calculate the inflation rate, we look at the current CPI minus the previous CPI divided by the previous CPI multiplied by 100. Now here is our example. Our previous CPI being 110, our current CPI being 120. Now we say the previous CPI, which is the current CPI, which is 120. Here we have 120. Then we subtract the previous CPI, which is 110. Remember, CPI is consumer price index. So we look at the current consumer price index we subtract the previous consumer price index, divide by the previous consumer price index, multiply by 100 because we are looking for a percentage. Now our inflation rate will be 100. Okay, an activity. Calculate the inflation rate if the previous CPI is equals to 150, the current CPI is equals to 180. How much will be the inflation rate? Can any one of you give me an answer? Let's calculate it together. How much is going to be our inflation rate? Do we have an answer? Mm.
20%.
No, guys. Raise your hand if you want to answer. How much is going to be our inflation rate?
20%.
20%. Hey, but no, you can't have you talking at the same time.
At least, wow. Try to speak around.
Take us through how you got to 20%. Malunala Bua on your own at the back and you are disturbing us. That is correct. The inflation rate will be 20% because we'll be saying previous CPI, current CPI, which is equals to 180 minus previous CPI, which is equals to 150. Times 100 over previous CPI, which is 150, and then the answer will be 20%. Thank you. Let's move to the next one. Now, the types of inflation. We have headline inflation, we have core inflation, we have administered price inflation. Now, with the headline inflation, it measures the overall inflation, including all goods and services in the CPI basket, in the consumer price index basket. It is commonly reported as the inflation rate. In other words, most of the time when we talk about the inflation rate, we are actually referring to the headline inflation. Now, the core inflation, this includes volatile items such as food and fuel. So when we measure the core inflation, we look at items such as food and inflation. These are goods that increases and decreases from time to time. The price of food, you can buy a loaf of bread today for 20 rands, and then the following day there is a sale. The price of bread is now 12 rand. Fuel prices changes from 1 month to the next. Hence, we say these are the volatile items. And when we calculate core inflation, we exclude them. Remember, with inflation, we said it's a general increase in the prices of goods and services. But when we look at the core inflation, although we are saying it's the general increase in the price, but the prices, the items such as the food and fuel are not included in the core inflation, but they are included in the headline inflation. Now, administered prices inflation, it refers to prices controlled by government or public institutions. Which ones are those? The electricity tariffs. You know, when Eskom wants to increase their tariffs, they cannot just decide that, okay, our tariff is now increasing from 8 rand to 12 rand. They still have to consult with the government, and the government must approve their tariff increase. The water charges. Municipality charges a flat rate for people who are not on prepaid. And even for people who are on prepaid, there is a certain amount per liter. So they cannot just charge as much as they want for such price for such items, because these are the items that are controlled by the government. Now, producer price index. We have spoken about the consumer price index and the producer price index. I'm not going to go back there. Let's look at the all-inclusive inflation. Now, all-inclusive inflation includes all categories of goods. It reflects the overall inflation experienced within the economy. Unlike with the core inflation, where we say the price of food and the price of fuel is excluded, when we look at the all-inclusive inflation, the name all-inclusive says it all. It includes all the categories of goods that are bought and sold in the country, and it gives us an overall inflation that we are experiencing in the economy as a whole. Okay, look at this. Now we look at hyperinflation. When we talk about hyperinflation, we say when something is hyper, you know, when you explain the words, when you explain the concepts, you also need to break them down. Hyper means something that is excessive. So inflation, we already described it. So we say with hyperinflation, there is extremely. The increase in the price of goods is extreme and uncontrollable. There is a rapid increase in the prices of goods, and this increase is extreme and it is uncontrollable. Now, with hyperinflation, money loses value very quickly. Remember what we said at the beginning. We said when inflation happens, the same amount of goods, they are going to become more expensive. We made an example of an item that you would buy for 100 rands. If the inflation rate becomes 5%, then it means you are going to buy that item for 105. Now, when we say there is hyperinflation, it means that item that you bought for 400 rand, the inflation now, because it's extreme, it can be, say, with hyperinflation, we can say about 50%. So which means the item will now become 150. Now, when this happens, what does that mean? It means you are going to pay 50% more for the item that you used to buy previously. Zimbabwe is an example of a country that has hyperinflation. In Zimbabwe, the prices of goods are extremely high. Then it means their money, the money that they have cannot buy the goods that they need to buy because goods are extremely high. Then it means the affordability level of households is very low. Not because they don't have money, but because the prices of goods are extremely high due to hyperinflation. And then we have what we call stagflation. When something is stagnant, it means it's not moving. But with stagflation, we say it occurs when inflation is high, economic growth is low, and unemployment is high. Now, in a country, when we experience high rate of inflation and there's no economic growth and more people are unemployed, then the situation is extremely bad because now prices are high, there's no much production of goods and services, and then people are not getting employment. So in other words, people do not have money, and as if that is not enough, they are unemployed, they don't have income, but at the same time, the prices of goods are very high. So their level of their standard of living becomes extremely low. Now we look at the two. In terms of inflation, we say that we have demand pull and cost push inflation. Now, inflation is caused by aggregate demand in the economy as well as aggregate supply. So the demand pull originates from the demand segment of the economy, whereas cost push originates from the supply segment of the economy. In other words, demand pull is caused by consumers. It emanates from increase in aggregate demand. Now, cost push is caused by, it emanates from producers. The more a production cost increases, the higher the prices that they are going to charge. Forgive my handwriting, ne? Now, this one, cost push, is also affected by aggregate demand, aggregate supply. Now, let's look at the differences between demand pull and cost push. How different is demand pull from cost push? We say demand pull is caused by excessive demand, while cost push is caused by rising production cost. Now we say demand pull inflation is caused by excessive demand. Remember what I said? We said demand pull originates from the demand side. It is affected by aggregate demand in the economy. While cost push, it originates from the supply side of the economy of the market and is caused by, it emanates from what happens in terms of aggregate supply. That is why we say demand pull is caused by excessive demand, while cost push is caused by rising production costs. Now with demand pull, we say when too much money is chasing too few goods. What does that mean? It means there's a lot of people have a lot of money and the goods are not enough to cover the demand. Can anyone tell me if that situation prevails, what is going to happen to the prices of goods? If there's a lot of demand, people have money, they want to buy more goods, but fewer goods are available. What is going to happen to the prices of goods? What does the law of demand say? No one. All right.
Ma'am,
Yes.
can you please start over to
Lena
the...
batho ba ka morao ba thole, ha ke kgone ho utlwa.
Can you please start over more with the types of inflation? Because no fast and we are lost.
The back slide.
Yeah, types of inflation. And
You want me to? You want?
lower pace here because we are too fast. Types of
Okay.
inflation. From the start, Miss. Mo.
Mona, we are here.
Kalon,
You want this
kalon.
one?
No.
No, we can't start from the beginning.
You are
I will
fast.
go to. Okay, I will slow my pace. And then at the end, I will go back and refresh you. Ne?
But now we are lost because we don't know who guy and what's going on.
Okay. All right. We are here. We are on the difference.
Lower your pace there.
We are here. We are on the differences between demand pull and cost push inflation. Let's start here. I'm going to lower my pace here, and then we will move, and then I will take you back to the beginning. Ne? So let's look at demand pull. I'm saying with demand pull is caused by excessive demand, meaning high demand. High demand causes demand pull, while cost push is caused by rising production costs. In other words, inflation can be caused by consumers buying more goods, or inflation can be caused by producers experiencing high production costs. Now, how does that happen? It means as consumers, if we buy more goods, we are increasing the demand for goods. And we know that when there is more demand for goods, the prices will increase. Luena, if you have a business and you see that maybe you are selling fat cakes, your fat cakes are R1 each. By 10 o'clock, all the fat cakes are sold. What are you going to do? You can see that people have more demand for your product, and the price, you are going to increase the price because you must make more profit out of that. That is why we say demand pull is caused by high demand for goods and services. Now, when we look at the cost push, we say cost push is caused by rising production costs. Remember, businesses always want to make profit. So when they want to make profit, their profit is determined by their production costs. If their production costs are less, they are going to charge lesser prices. But if their production costs are rising, they are going to charge more prices. And remember, we said with inflation, the general increase in the price of goods and services is inflation. So if the production costs of producers are high and the producers are charging us high prices because of their high production costs, then that is going to cause inflation. Now, the second one, we say demand pull inflation happens when too much money is chasing too few goods. What does that mean? It means people have a lot of money, but the goods that are available in the market, they are very few. So because there's a lot of money and few goods, prices are going to increase. And this is, we say this is regarded as demand pull inflation. Sorry. Whereas cost push inflation emanates from production costs becoming more expensive. So the first bullet and the second one are almost the same. It's only that now with the second bullet, we are now explaining why do we have excess demand. We have excess demand because there is too much money in the economy and there are too few goods. So more money, few goods, prices increase. Demand pull inflation usually occurs during economic growth. Let us now think about it. When there is economic growth, the country is producing more goods and services. The economy is growing. The production capacity of the country is growing. More people get jobs. So during economic growth, more people get jobs. So when more people get jobs, there is too much money in the economy. Now, because of that, because the economy is growing and people have jobs and they have more money, they buy more goods. Then we say cost push inflation, on the other hand, it can occur during economic decline. During economic decline, there is less demand for goods and services, but the producers may still incur high costs. So because of that, they are still going to charge high costs as long as their production costs are high, regardless of whether the economy is on the upward trend or on a downward trend. But with demand pull cannot happen if the economy is declining, because when the economy is declining, one of the things that happen is that people lose jobs. So when people lose jobs, they cannot have enough money to buy goods and services. So demand for goods and services will decrease. That is why we say demand pull inflation occurs during economic growth, while cost push inflation can also occur when the economy is declining. But when the economy is declining, we can never have demand pull inflation because people do not have more money when the economy is declining. Now, the other thing we say, higher consumer spending results into demand pull inflation. What causes that? Higher consumer spending. The more we spend, then we push the prices up in terms of demand pull. Higher wages, high fuel prices, and the high cost of raw materials results into cost push inflation. So look at this. When consumers get jobs, it means for the business, there are production costs in the form of wages. So it's a catch-22. More people get jobs, they spend more money, they cause demand pull inflation. And when more people get jobs, the businesses, they will be employing more people. Then they have more wages. Or sometimes they didn't even employ more people, but the workers are demanding an increase in their wages. So when they want higher wages, it means what is going to happen? The production cost of the business is going to increase. Now, remember we said cost push inflation is caused by rising production costs. So when the business experiences high wages, they are going to have more production costs. If the price of fuel increases, And you know, most businesses will want to distribute goods, get raw materials from the primary sector and distribute their finished goods to the tertiary sector. So fuel is one of the production costs that businesses incur. So if the fuel price increases, it means businesses are going to incur higher production costs. And when they incur higher production costs, they increase the prices of goods and services and cause inflation. Right. Demand pull inflation leads to increased output at the initial stage, because people now want to buy more goods, then businesses will want to produce more. But with cost push, it often reduces output and employment. Remember, always remember, cost push relates to the production costs. Demand pull relates to the demand in the economy. Now we say cost push reduces output and employment. What does that mean? Because of cost push, remember, cost push is caused by the production costs. So if businesses are experiencing high production costs, they will not produce more goods because their production costs are very high. So if they don't produce more goods, it means the output decreases. The number of goods that the business is going to produce decreases. And when the production costs are high and businesses are not making enough profit, what do? They retrench workers. Now, that is why we say it reduces output as well as employment. Now, we have these two approaches to inflation, the monetarist view and the Keynesian view. According to the monetarist view, inflation is caused by excessive growth in money supply. Too much money in circulation, and this creates excessive demand. It is true, ne? We said when there is more money in the economy, people demand more goods. And when they demand more goods, they cause the prices of goods to increase. So when there's more money in circulation, there's high demand. Now, what should happen? Now, according to the monetarist view, they want government intervention. The government must intervene to control money supply. In other words, according to the monetarist view, they feel that inflation cannot be controlled if the government is not involved in controlling money supply. The Keynesian view, on the other hand, they have a view that inflation is caused by excessive aggregate demand. The monetarists believe that inflation is caused by excessive growth of money when there is more money supply. Whereas the Keynesians believe that inflation is caused by excessive demand. Now they say government spending, household spending, investment can create inflation. According to this view, inflation is caused by more government spending. Remember, more government spending is an injection in the economy. More consumer spending. When consumers spend more, the marginal propensity to consume more increases, and we know that the multiplier will increase. And then they also believe that inflation may also rise from cost push factors such as wages and energy cost. So the difference between these two is that the monetarists, their view is that people the government should control how much money is available in circulation. Whereas the Keynesian view, they say, if we can only control aggregate demand, then we are going to contain inflation. If the government spending is not increasing and household spending is not increasing, then inflation will not increase. That is according to the Keynesian view. Now we look at demand pull now in isolation. What causes demand pull inflation? Foreigners further increase the demand for our goods and services through an increase in exports. What do we mean? When there is an increase in exports, meaning other countries demand more goods from our country, what are we going to do? We increase the prices of goods because we are now able to make more profit out of that. And when those prices increase, they don't only increase for foreigners who we sell goods to, they increase also for us who are in the country. Now, another cause of demand pull inflation is an increase in the aggregate demand components. Which are the aggregate demand components? Consumer spending, investment spending, government spending, and the cost of inputs or the cost of imports. So when all of this increases, then there's going to be more aggregate demand, and higher aggregate demand is going to lead to demand pull inflation. Decline in savings. Let's make an example. If you have a salary of 10,000 and your savings is equals to 4,000, then it means your disposable income is equals to 6,000. I get. So meaning out of this, in as much as your salary was 10,000, 4,000 was saved. So the money that is available for you to spend is 6,000. But if the savings is no longer 4,000, then you decrease your savings to 2,000. It means okay, now we say, let's erase this so that we can see. If your savings is no longer 4,000, it is now 2,000, what is going to happen? It means your disposable income will no longer be 6,000, but it is now going to be 8,000, meaning 8,000 is the money that is available for you to spend. So what is going to happen? If the savings decline, it causes inflation because consumers start spending their current income. They spend all the 8,000. So when they spend all the 8,000, it means the demand for goods are increasing. Okay, let's look at personal income tax. If the personal income tax is reduced, it means there is more money available. Your salary, 12,000. Tax, 4,000. Disposable income, 8,000. So what is going to happen? If the personal tax is reduced, now it means you have 12,000. Your tax it has reduced from 4,000 to 2,500. Your disposable income is going to be how much? 9,500. Am I right? Your disposable income becomes 9,500. Now, in other words, you have more money to spend. Your money that is available to spend is no longer 8,000, it is now 9,500. So when your disposable income increases, it means consumption, expenditure also increase. Now, another cause of demand pull is access to credit. When people are able to take more loans, more overdrafts, they are able to have more money to spend, and they are going to demand more goods and services. And whenever demand for goods and services increases, we already know that we are going to experience demand pull inflation. Now, as aggregate demand increases, aggregate demand increase more people have access to credit. The personal income tax is decreasing. There is a decline in savings. Now, when all of that happens, the price level is also going to increase. Now, the other thing is that the initial increase in demand will have a positive influence in production. At the first point, when demand increases, producers in the short run are going to produce more. And there's going to be more employment, more income. But when full capacity is reached, the prices now, further demand, increase in demand is now going to cause an increase in prices. Now let's look at it like this. People have more disposable income, they have more access to credit, and they demand more goods. Fine. When they demand more goods, the producers are able to produce more in order to meet demand. When they produce more, they create employment. People get jobs. When there are more jobs available, there is more income in the economy. So people are employed, production is high, more money is available in the economy, which is good. The economy is flourishing. But remember, immediately people have more money to spend. Immediately they have more income. They are going to spend more. And any level of expenditure that is increasing, in the long run, it leads to an increase in the prices of goods, which is going to cause inflation. I hope I'm not moving as fast as I did. Now, causes of demand pull, we are still going on. Increase in household consumption. This is a summary of what we just said. Due to available credit, due to reduction in taxes, and less savings will cause an increase in the demand for goods and services. Investors' expenditure may lead to high profit expectations for businesses. They will invest more, and this will lead to an increase in the demand for goods and services. Government expenditure. An increase in government spending means more money comes in. This is supposed to be part of the first bullet. More money comes into circulation due to increase in infrastructure. Increase in government spending leads to increase in infrastructure. increase in consumption spending, increase in social spending, and which will lead to more income. What happens when people have more income? They are going to spend more. There's going to be more aggregate demand in the economy. And then when that happens, the prices of goods are increasing. Export earnings. When we export goods to other countries, there is an injection into the economy because money is flowing in because we are exporting goods and we earn foreign exchange. The growth in foreign countries may create an increase in locally produced goods without an increase in production. What does this mean? We say when export earnings increases, there's going to be, the more we export to other countries, there's a high demand for goods. Actually, it means because there is high demand for goods in other countries, we are able to export more and earn more money in terms of export earnings. But what is not good about that is that the locally produced goods will also, the demand for locally produced goods will increase, but there is no increase in production. It means we are selling, there is more demand for our products in other countries. So because there are more products in other countries, it does not necessarily mean automatically we will be able to produce more. Now, if we are not able to increase production to meet demand, it means we are going to have a shortage. For example, if the demand for our goods is equals to 200 items, but we are only able to supply 150, it means we have a shortage. A shortage of 50 items. Now, when we have a shortage, the immediate thing that is going to happen is that prices will be increased so that demand decreases to meet the goods that are available in the economy. So in as much as when we export, we earn money in terms of export earnings, it is also not good because now if there's more demand for our goods and we are not able to produce, the prices are increasing. And the prices that increase, they are not increasing for exports only. They are also increasing for us as domestic consumers. So inflation happens because of that. Now let's look at cost push. Remember we said cost push is mainly caused by increase in the production costs. Now, an increase in wages. Remember, wages is also a production cost. Now we say an increase in wages is one of the major causes of cost push inflation, because if wages increase, it means businesses are incurring more production costs. And when there are more production costs, we are going to experience the cost push inflation. When the prices of key input goods that are imported increase, domestic cost of production increases, especially in the manufacturing sector. Now, what does this sentence mean? It means our manufacturing sector, they sometimes import their inputs. Let's think of raw materials. they import raw materials. Now, if the price of imported raw materials increases, it means the cost of production is going to increase. Our manufacturing businesses need the raw materials from other countries. Now, when they buy raw materials from other countries, and it so happens that the prices of those raw materials in those countries that we are buying from increases, then it means the cost of production is going to increase because the price of raw materials is increasing. So when that happens, it means they are going to charge us more because they are spending more in terms of producing those items. Depreciation of the rand. When the rand loses value, imports become expensive. I give the first one, the prices of these raw materials. Now with this one, we are looking at the value of the rand. Now, these businesses, these ones that are manufacturing and they import raw materials, if the rand depreciates and the imports become expensive, it means the raw materials that they are importing is also becoming expensive. And whenever their raw materials becomes expensive, their production cost increases and they are going to charge us more prices. And that is cost push inflation. When businesses increase their profit margins, their cost of production and prices that consumers pay will also increase. In other words, people who are doing accounting, most businesses have profit margins. If a business has a profit margin of 15%, it means they are charging 15% profit in their operations. 15% is a profit. Now, if they increase their profit margins to 20%, are we still going to say to pay the same prices? No, we are not going to say to pay the same prices, not because there was an increase in the cost of production, but this time there's an increase in the profit margin, meaning the business is now looking at increasing their profit, but they don't increase their profit. The method that they use to increase their profit is by increasing their profit margins. So when they increase their profit margins, they charge us, they want to get 20% profit. In other words, an item that they used to sell at 150, an item that they used to sell for 115 with a profit margin of 15%, the same item they are now selling for 120 because their profit margin has increased from 15 to 20. Now it means we are no longer buying this item for 115. We now have to buy it for 120. Less productive factors of production lead to increase in the cost per unit. Meaning, when the factors of production are less productive, we use more inputs to produce the same amount of output. We are using, let's say, our production costs are 200 per item. Now, if they are, and then out of this 200 costs, we are able to produce 10 goods. Now, if there is less productive factors of production, it means there is no productivity. We use the same inputs, 200, but now we are no longer able to produce 10 items. Now we are producing, say, 7. Well, now these two scenarios means that the production costs are becoming expensive. If you can produce, say, if you can use 200 to produce 7 items, whereas in the past you used 200 to produce 10 items, it means you are no longer productive. You are using more resources, but you are getting less output. So that is also going to increase the cost per unit. And whenever the cost increases, the prices that are charged to consumers also increase. Another thing that causes cost push inflation is things such as droughts, floods, and global warming. Let's think of the agricultural, the farming sector. When there are droughts, it means there was not enough rainfall. So the agriculture becomes hard hitting when there are no rainfalls. If the rainfall is not as good as it's supposed to be, they will not be able to produce the same amount of goods that is expected. The floods are also one of the factors that affect the agricultural sector, because if there are floods, it means their production will be swept out. So they are going to lose in terms of the number of goods that they used to produce. The consequences of inflation. We have looked at what inflation is, what causes inflation. Now we are looking at how does inflation affect us as people. Debtors and creditors. Now we say inflation benefits debtors. Debtors generally benefit from inflation because they repay loans with money that has a lesser purchasing power than when they borrowed it. Now, what does this mean? It means when inflation happens, the money that you borrowed, you are now going to pay it back with a lesser purchasing power. Let's make an example. I borrow you 500 and inflation at the time is 2%. Now, when you pay my money back, you still pay 500. Now, inflation is 5%. In other words, it means the item that I was able to buy with 500, if inflation is now 5%, I will no longer be able to buy that. Marwena, you received the money with a good purchasing power and you are returning it with a lower purchasing power. I don't know if you understand that explanation. We say, when let's make an example. You borrow me 500 and I'm able to buy a pair of shoes. But when I pay you this money, a pair of shoes is no longer 500. It is now 550 because of inflation. Now it means when I pay you back your 500, wena, you will no longer be able to buy this pair of shoes. So now as a debtor, I would have benefited because the money that you borrowed me was able to make me to buy shoes. But when I repay it, it's no longer enough for you to buy shoes. That is why we say debtors generally benefit from inflation because they repay their loans with money that has less purchasing power. Now, if wages and profits increases during inflation, debtors may find it easier to repay their loans because now they have more money. The wages has, if they were, the money that they earned previously has increased. Now it means they are able to repay their debts. It makes it easier for them to repay the money because now the money has, their wages is increasing, but the money that they are repaying has got lesser purchasing power. Creditors lose because the money they receive back is worth less than what when it was lent. The same example that I gave. When I repay you your money back and the inflation is 5%, you will not longer be able to buy the same goods as a creditor. Now, as a debtor, I would have benefited because when you gave me your money, I was able to buy items that you are no longer able to buy when I repay you back your money. Then we have fixed interest loans. The fixed interest loans become less profitable because the purchasing power of the repaid money decreases. Now, interest rates can either be fixed or flexible. When they are flexible, they change according to they change from time to time. You know, most the interest rates are dependent on the repo rate. But when we had an agreement or you borrowed money in a fixed interest rate, it means whether inflation is 9% or 12%, if we agreed that I'm going to pay you back with an interest of 5%, if inflation is 8%, I don't pay you more than 5%. I will still pay you 5%. So it means the money that you are now getting back as a creditor has got lesser purchasing power because of inflation. Then we look at the taxpayers. Inflation can increase the tax burden on individuals as well as businesses because people move into higher tax brackets, even if their real income has not increased. So the real income is the money that you can afford to buy goods and services with. So when inflation increases, it becomes difficult because now the money that you have is no longer able to afford you to buy the same number of goods that you used to buy. And it doesn't mean now because inflation has increased, your tax is now decreasing so that you have more disposable income. You will still be paying the same tax or maybe a higher tax if the wage has increased. But because of inflation, even when your wages has increased, you will still buy lesser goods because the prices of goods is now higher than where they were before. And the third thing is that workers will always pay tax. We pay tax despite having little or no increase in the purchasing power. So whether inflation is high or inflation is decreasing, the tax that we pay remains the same. You still pay, if your tax is 15%, you still pay 15%, even if the inflation is now increasing. So because of that, it means people now are able to buy lesser goods, even if not because they have less money, but because the money that they have can no longer afford them to buy more the same number of goods and services because of inflation. Now, taxpayers' disposable income may decrease, creating a feeling of unfairness among taxpayers. It becomes unfair when we are paying tax. At the same time, now the inflation rate is high. We can no longer afford the same goods that we used to afford. And the standard of living, remember, if you can no longer afford the same goods that you used to afford, it means your standard of living is now decreasing. Then we look at the wages and salary earners. Wages and salary earners often suffer. Wages and salary earners, they suffer during the period of inflation. Why do they suffer? Because the prices of food, the prices of transport, the prices of housing, and other expenses rise faster than their wages. The prices of goods are increasing, but the wages are not increasing on the same pace. So they will still be unable to afford the same goods that they used to afford. When inflation increases, the wage earners, they still earn the same wage. But on the other hand, the prices of goods is increasing at a faster pace, such that they can no longer afford the same goods that they used to afford. Now, we say inflation causes workers to experience a decline in their real income. It doesn't mean because of inflation, if you used to earn 1,000, you are now earning 800. No, that is not the case. It means the same goods that you used to afford when there was no inflation, your salary is still 1,000. But because the prices are increasing, you can no longer afford the same goods that you used to afford. That is why we say your real income is declining. And when that happens, the standard of living falls because they cannot afford as much as before. If you used to take your kids to a restaurant twice a month, and the prices of food is now very expensive, you can no longer be able to take them twice a month. Maybe you'll take them once a month, or you'll take them out once in 3 months. So that says your standard of living has fallen. Investors and savers. Uncertainty caused by inflation discourages investment. Because businesses are unable to predict the cost. Remember, businesses always want to have lower production costs. So if there is a lot of uncertainty and then inflation is going up, and every now and then inflation moves from 3%, the following, maybe after three months, it's now 4.5, then the prices are not stable. Inflation is continuing to increase. Businesses are not encouraged to. Remember, with investment in business is when the people invest money in expanding their businesses or establishing new businesses. So when the inflation rate is moving up and down continuously, it causes them to be unsure. Uncertainty means they are unsure. Because they are so uncertain, they don't want to put their money in, and then imagine you taking your money, starting a new business, and then inflation becomes high. People are not able to buy goods from you, it means you will not be able to make profit. So because that makes them to be uncertain and it discourages them from investing. Investors in property, shares, and other real estate, they may benefit from all of this because the value of their assets tend to rise with inflation. In other words, if you are an investor in property, remember, land and buildings, they always appreciate. Ne? So if you are an investor in property and there is inflation, it means the value of your property is increasing. And in that way, you are able to benefit. Okay, continued industrial stability. It's so small and invisible. We have here industrial stability. Now, with industrial stability, we say workers demand high wages to keep up with the rising living costs. Remember, we said when there is inflation, the same money that you have will no longer afford you to buy the same goods. So what do workers do? They demand high wages. They demand high wages so that they can still afford the same goods that they used to afford, so that their standard of living does not decrease. Now, employers, on the other hand, they resist wage demands. Workers want high wages. Employers do not want to give high wages. Why do employers not want to give high wages? Because it increases their production costs. It makes them to have more money spending on the costs and less profit. When this happens, it causes labor disputes. Workers are going on strikes now. But then there is industrial instability. When they go on strikes, production is disrupted. Businesses become inefficient. Remember, workers, when they want money, they always go on strike. And if employers are not able to give them that money, it means they will not go to work, there will be strikes. And when that happens, businesses are also suffering because production is interrupted. And when production is interrupted, they are not able to make more profit because there is no production happening. Now, this happens because high inflation causes workers to demand high wages. Unemployment and poverty. Inflation can contribute to high unemployment as businesses face higher production costs and they reduce their operations and retrench workers to cut the costs. Now, remember, when inflation is high, we said there is less demand for goods and services because people cannot afford the same goods that they used to afford because of inflation. Now, if people are no longer able to buy the same goods that they used to buy because of inflation, it means businesses will not be able to make more profit. When they are unable to make more profit, they are going to retrench workers in order to cut the costs. Inflation harms low-income earners because they now spend a greater proportion of their income on necessities. For instance, even if your income is 3,000, when inflation increases, you still need to buy food. You still need to pay transport to go to work to earn that 3,000. Okay. So Low-income earners, they suffer the most because now most of their income is now spent on their necessities. These are things that they cannot do without. They must still buy regardless of the increase in the inflation. So these ones are also one of the most affected because food will still have to be bought. Even if the bread is expensive, we still buy bread. Now it means we are going to now spend more money on the necessities and not have anything left. The rising process makes their savings to become less. Out of the 3,000, if they were able to save maybe 400 a month, better stokvel, they are no longer able to do that because now all of this money is going to necessities. They can no longer save. Or if they used to save 400, they can now only afford to save 100 rands. Another consequence of inflation is the balance of payment problems. Balance of payments, remember, is that statement that is compiled to show the transactions that we have with other countries. Now, how is the balance of payment affected? Remember, we did the balance of payment in term 1 when we were doing the foreign exchange market. Now, how does inflation now relate to the balance of payment? The inflation causes domestic goods to become expensive. Our South African goods are becoming expensive because of inflation. Now, what happens? Expensive domestic goods, because of inflation, the goods become expensive. Foreigners buy fewer goods. This reduces our export earnings and results into a balance of payment deficit. Now, how does that happen? When we export goods, we earn money from foreign countries. So the more we export, the more injections come into the country in the form of export earnings. Now, when our goods become expensive, the foreigners will no longer be able to buy. What does that mean? It means now less money is coming into the country. We are now going to have less export earnings. Remember, for us to have a surplus in the balance of payment, it means exports must be greater than imports. A deficit happens when exports are lesser than imports, right? So we always want to have a surplus in the balance of payments. It's a good thing for us as a country. But if our products are now expensive, it means the exports are going to decrease because foreign countries will buy fewer goods from us and we are going to get lesser export earnings. So it means now when our exports are decreasing, we may even find ourselves having a deficit, which is not good. High domestic prices will cause consumers to prefer cheaper imports. But high goods domestically, the foreign countries, they are going to buy lesser from us. On the other hand, if our goods are now expensive, the South Africans now are going to buy goods from other countries, which means they are going to increase the imports. So if we have more imports than exports, our balance of payment is going to have a deficit. Now, when that happens, the trade deficits grow and the country's currency may become weak, meaning there's going to be a depreciation in the rand. Psychological influence. How does inflation affect us psychologically? Inflation affects people's behavior, expectations, and attitudes, and may make them to buy before goods increase further. So what do we mean here? We say when we expect goods to increase, when we expect the price of goods to increase, we buy in advance in order to buy these goods and have them before the prices increase. For example, you know when there's going to be an increase in the price of petrol, and then the motorists know that on Tuesday midnight, the price of petrol is going to increase. What do? They make sure that before the price of petrol increases, they fill up their cars, they are on full tank. But they don't realize that when they fill up their tanks, all of us go to the petrol station and fill up the tanks. We are actually creating a high demand for petrol. And as a result, now the inflation, the price of petrol will actually increase even further because now the demand has increased. Consumers become anxious about future living costs, which may result in panic buying. That is also what we call panic buying. Because now people are anxious. They are worried that, if petrol increases, it means full tank will no longer take me the whole month. Let me somehow fill it up so that I still spend the same money for my full tank for this month. But next month, they are going to spend more because they cost the price of petrol they are actually the ones who caused it to increase in actual sense because they created a high demand for petrol. Businesses may increase prices in anticipation of future cost increase. When businesses think that there's going to be an increase in their future cost, they increase the prices already so that they are able to cover their production costs. So because of this anticipation, they increase the prices. And when they increase the prices, they cause inflation. They cause the inflation rate to rise. Now, how do we control inflation? These are the measures that can be taken in order to control inflation. So we have three measures. We have the monetary policy, the fiscal policy, and the other measures. Remember, we don't want people's standard of living to drop. We don't want businesses closing down because they have high production costs and people losing jobs. So the government always wants to come up with means to ensure that the inflation is within the target. And our inflation target is 3 to 6%. I know the recent information is that the Reserve Bank says the target is only 3%. But for our curriculum, we are still talking about the inflation target of 3 to 6%. Now, if inflation increases beyond 6%, we are going to experience hyperinflation, and we don't want that. Now, how do we ensure that we are still within the inflation target? By means of the monetary policy. Now, with the monetary policy, remember the monetary policy is the responsibility of the South African Reserve Bank and not the government. Ne? Now, the Reserve Bank can increase the repo rate. When the repo rate increases, it means there's going to be an increase in the interest rates as well. Now, why do they increase the repo rate? In order to make borrowing more expensive. Remember what we said previously. We said inflation is caused by too much access to credit. When people have got more access to loans and overdrafts, they spend more. So in order to control their spending, the Reserve Bank will then increase the repo rate so that the interest rates also increase. And when the interest rates increases, borrowing becomes expensive. Commercial banks will increase their interest rates. Remember, from the repo rate to the interest rate. When the repo rate increases, the interest rate increases. Then they are going to charge consumers more, and this is going to be expensive for households and businesses to borrow money. So when households are not able to borrow money, it means aggregate demand is going to decrease. There's going to be less demand for goods. Aggregate demand will decrease. Again, they increase the repo rate to make borrowing more expensive so that households can reduce their spending on goods and services, particularly on items that are commonly purchased using credit, like cars. We don't buy food on credit most. So basically, when the interest rates increases, the aim is for households to buy fewer items that they usually buy using credit. To reduce households' consumption, business investments, causing aggregate demand to decrease. Producers will experience less pressure to increase their prices. Consequently, the rate of inflation will be reduced. Now, with high repo rate, households' consumption is going to decrease. What makes it to decrease? Because borrowing is expensive. They no longer have more access to credit. So they will not, the aggregate demand in the economy is going to decrease. The decrease in the repo rate also will encourage households to save more. High interest rates, less spending, and more saving. Why is it that way? Because if you save your money, say you save 1,000 with an interest rate of 3%. If the repo rate increases and the interest rate increases, it means your saving of 1,000 with an interest rate of 5% is going to give you more returns. So when the interest rate increases to 5%, then households are able to save more because they want to get more returns. And when they save more, what happens? They have less money to spend, and they are taking their money to savings, and then they increase their savings. So increasing savings means less money to spend, more money saved, more interest earned. The Reserve Bank may also increase the interest rates to reduce excessive demand and to prevent businesses and consumers from expecting continuous higher prices. The Reserve Bank can therefore help to anchor inflation expectations to prevent temporary supply-side price increase. Supply-side increase is that one that is caused by cost push. Remember, we said cost push whenever the price increase as a result of any changes in the supply, we refer to that as cost push. Now, we say on the other hand, excessive increase in interest rates can also reduce economic growth, which is not good. It can reduce economic growth. When the interest rates are too high, economic growth is going to decrease. Unemployment is also going to decrease because households and businesses reduce their spending. Remember, for economy to increase, there has to be more production. Now, let's look at it. If households are reducing their spending, they spend less on goods and services. It means the aggregate demand is going to decrease. Now, when aggregate demand decreases, producers will now produce less. Who are they producing for? If interest rates are high, it can cause a reduction in economic growth because there is a reduction in spending. Households are not spending more. So demand for goods and services decrease and producers are going to produce less. Then it means the economic growth is going to decline. Let's look at the fiscal policy. With the fiscal policy, remember the fiscal policy is the responsibility of the government, where we use taxation and government spending to control the economy. Now, with the fiscal policy, we say the government can use contractionary fiscal policy to reduce excessive government spending. Government can reduce its expenditure. That is a contractionary fiscal policy. With contractionary fiscal policy, we reduce government spending, we increase taxes. Now, when the government reduces their expenditure on goods and services, less money is injected into the economy. Now, when less money is injected into the economy, the demand will decrease. Remember, one of the things that the government can do is to come up with infrastructure projects that create employment. But if they reduce their government spending, they will not come up with such projects. So less people will not have jobs and the demand for goods and services will decrease. Whenever there's a decrease in the price, in the demand, the prices are forced to go down. Government can also increase taxes. Now, when they increase taxes, how is that going to help inflation? Households will pay more taxes. Their disposable income will decrease. And there will be less money available for consumption. Now, it means high taxes. When the government increases high taxes, it means households pay more money, they have less money, disposable income, they spend less, and inflationary pressure will be reduced. Higher taxes can also reduce spending capacity of businesses. and individuals. And that is going to reduce demand in the economy. When businesses pay high corporate tax, it means that their profits are going to decrease. And when the profits decrease, they will not be able to produce more. The government can therefore use a combination, meaning they can use government spending as well as taxation. How do they use them together? They reduce government spending, but on the other hand, they increase taxation so that they can reduce demand pull inflation. So those are the things that the government can do using the fiscal policy. Other methods, or we're still on the fiscal measures. The government can provide subsidies. Subsidies is one of the government expenditure methods. Now, when they give subsidies, what are they seeking to achieve? They are helping the producers so that their production costs, when they are essential for the production costs, and the government gives the producers money in the form of subsidies in order to relieve them from the production costs. Now, when they are not paying high production costs, they are going to charge us less prices. So the government is helping us in terms of the ultimate price that we are going to pay by means of giving subsidies to the business so that businesses can reduce their production costs and charge us less prices. Because if there are no subsidies and the production costs are high, the prices are going to be passed to us as consumers in the form of higher prices to cover the production costs that are so high. The government can also reduce taxes on or import duties. The lower taxes on inputs can reduce the cost of production. Remember, whenever the cost of production are less, it means we are going to pay lower prices. The government can further address cost push inflation by investing in infrastructure, such as electricity generation, roads, railways, etc. Now, how does this help us? Improved infrastructure reduces the production costs. Remember, every time the production costs are reduced, the prices we pay are going to be lesser. Government can also provide incentives to businesses to increase their production capacity and to improve productivity. When firms are able to produce more at lower cost, then they are going to charge us less prices. Therefore, the fiscal measures are aimed at cost push and mainly to reduce the production costs and to increase aggregate demand. Because now, when the production costs are less and aggregate supply is more, remember the law of supply, when there are more goods supplied, the prices go down. Suppliers always they supply more when prices are high. But now, because of the subsidies, the government is able to meet them halfway in terms of the production costs. So they are able to increase aggregate supply because their production costs are less.